think if I've got three key messages for directors in this current environment, they'd be: one, don't be frightened or reticent to seek advice. Get that advice early is number two. The earlier you can come to professionals, the more options that are available. And the third, and it's the lawyer in me, is make sure you document your decisions extremely carefully. Not just the decision, but the reasons behind the decision, particularly with a focus on looking after your creditors and your stakeholders.
I guess we're talking about corporate recovery and insolvency today, and against the backdrop of we're now 3 or 4 years into the period post the recession in 2008, which we all thought would be over in 12, 18 months. It's clearly not.
Yeah. And indeed, I think 9% up were the insolvency stats for the last quarter on this time last year. And Mervyn King's announcement yesterday kind of makes the backdrop even more challenging.
Yeah, what did he say exactly? It was possibly the
worst financial crisis in history, basically.
Yeah, and facing not just the UK.
I think that's what we're facing. I think that's what businesses are facing out there, is this constant media story of doom and gloom. And actually, we work within the professions. We deal with underperforming businesses, and I guess it's interesting to try and correlate what the media is saying to what the reality on the ground is for us.
It's particularly interesting, isn't it, when you see all the sort of national headline European stories trying to relate that back to your SME business and your director out there trying to earn an honest living with a good core fundamental business.
And I think also, we were speaking the other day, Nigel, and you said that your client base is lacking confidence.
It is.
And if there's no confidence, that's very hard to move on and grow from that. But
we can't. There's no signs of any growth being really generated by any of the stimulus that's being put out there.
No, I mean, the 75 billion injection doesn't, well, who knows what it's going to achieve, but certainly the previous injections don't seem to have kick-started the economy to the extent that perhaps the government had hoped.
One of the things from a banking perspective, we often face is a perception about when does a business that is struggling or perceiving it's got some issues for the future, when does it actually say it's got some problems, own up to those problems, admit to those problems, and then actually who's it going to speak to? And one of the things that I find from a banking perspective is a perception that they shouldn't go to their bank early, and that's something I think is absolutely wrong.
I think the businesses I deal with don't always recognise what the warning signs are, so they don't know quite when the right time is to go and ask for help.
Yeah.
And then the second point is they don't actually know who to go and ask for help. So they'll often come to me, but actually, a lawyer can only give one aspect of what is needed.
Well, there are some very classic warning signs, aren't there, which show themselves in cash flow pressures. Yes. And often the lender is the first person to see those pressures pull, aren't they?
Well, cash never lies. It's like a photograph, isn't it? So, so it will come out within cash. But I think you're right. The issue is that there are many warning signs. They can be very different for different sorts of businesses. I guess the advice that we like to bring back to our own client base and within our own staff as well is think about, an event. Is it an adverse event? Is there a loss of a customer? Is there management disharmony? All sorts of warning signs. But actually think about that. Is it a good event or a bad event? And the impact of that. High, medium or low.
Yeah, and the warning signs don't always indicate an impending insolvency, do they? I mean, it can be often a short-term working capital problem that can be caused by seasonal sales activity. It can be caused by possibly a one-off bad debt or something like that. That doesn't necessarily mean insolvency, but if directors are being sensible, they should sort of step back, consider, how fundamental an effect does that have on their business?
I think we sometimes see, though, let's say there's loss of a major contract. There's often a tendency for directors to think, it will come good. Yeah. And so there's a stalling of time, and obviously that all of that time pressure delays the options that can be put in place. So it's not only recognising, it's actually doing something proactively
I agree.
with it,
I mean,
isn't
it's never too early to seek help.
What about sort of legal issues, Joanne? If a company decides not to raise a problem with the bank and leaves it for a month, hoping some solution will just magically
miraculously land in its lap.
materialise, are there other sort of legal issues the directors face by doing that?
Yeah, I mean, obviously there are. They've got to be mindful around their directors' duties obligations. But I think, a lot of directors read about it or are told about it, and it almost scares them. And actually, if you're working prudently towards a good plan, you're talking to your stakeholders, you're bringing people on board in what you're trying to achieve, then actually it's pretty much business as usual, but probably a bit more cautious around, making sure you document your evidence. I think directors can run scared of it, and actually it's more about sitting up, making sure they're doing things, as they should be, than worrying about it too much.
So in terms of where the directors of a business that's in difficulty, where do they go to get help? They could go to their accountants, their lawyers, their bankers, they could go to an independent insolvency advisor. What do you tend to see, Paul, in terms of where they go first?
I think my advice around this subject is the first step when there is a problem and management of a business understand there is a problem, they face up to that, is think about their trusted advisors. Who have they got around them? You've touched them already. They will have a lawyer on board, they will have an accountant, they will have a banking relationship. So I wouldn't advocate they just pick up the yellow pages and call an independent specialist out of the blue. I think go through your trusted advisors first, ask for help, and those trusted advisors will normally come into specialist advisors to deal with the situation, and that's the right route, is getting there as quickly as possible with some trusted advisors
and
around
those
you.
trusted advisors then know who the right expertise, or who has the right expertise to deliver what's required, because let's face it, every business recovery situation is different. Every business is different and the challenges are different.
And they need a blend of advice, don't they? It's not just enough to get legal advice on its own or advice about their banking facilities or insolvency advice. They really need to pool those three forms of advice together, and that will help them find a way forward.
Absolutely.
What about cost? Do we think directors are concerned that they're in financial difficulties, going to take legal advice, going to take accounting advice? Isn't that just going to add another level of cost onto the business that they actually can't afford?
Businesses, I think, need to think wider and further forward than that, because it's all about what's the cost of not taking the advice. What's the end objective?
Not to do it, isn't it?
And maybe some, and there typically is some upfront costs, so there'll be some costs around a restructuring or a turnaround. But actually, if businesses remain in denial, don't take the right specialist advice, and the options run out, then the cost is huge.
And most advisors will be willing to meet with a board of directors for a couple of hours at no cost, really, won't they?
And then, of course, the costs get worked into the cash flows in terms of what your plan is that you're working to, and the sensitivities around it.
Well, what do you think? Do you think directors are concerned about almost going public with a problem, actually, that the effect that might have on their customers or their suppliers if they were to find out that they're taking advice around insolvency?
That's one of the things when directors come to me, it's one of the main things. They say, well, I can't possibly talk to the bank because as soon as the bank knows they're going to do X, or I can't possibly speak to my key supplier because they'll just turn us off, they'll turn the tap off. And actually, it's about the tone of the conversation, how you position it, what you're trying to get out of it, that you need to think through before you pick the telephone up.
The worst thing to do, as we know, is to not communicate with a key stakeholder, because no communication will then lead to people thinking the worst is happening, and that could lead to a knee-jerk type reaction. There's no need to get to that point.
And directors really don't need to think that the bank is just immediately going to pull the plug when they raise the question.
Absolutely not. No, banks are there to support businesses. They have specialist support teams. They're commercial businesses as well that are looking to have long-term sustainable profits themselves. So pulling the plug, which could be the sort of common perception, one, that doesn't happen very often at all, and secondly, it's not good news for the bank. One thing that we do see a lot of is lots of successful turnaround, improvement, recovery plans. I see many more of those than I see of the ones that don't work, which is really pleasing to see, and that's contrary to the media sort of perception around it.
I think the first thing for me is there has to be some tangible change. You can't just carry on doing the same thing because it won't improve. There has to be some tangible change to the business. You have to have a good core business that can get through this problem and can prosper into the future. That's probably the first thing I would look at in trying to achieve a turnaround is what's gone wrong, understanding what's gone wrong, and what are we going to do to put those things right and stop them going wrong again in the future. And if you can't do that, you won't turn it round.
Yeah, and I think one of the things we see is there needs to be a willingness and a desire and a will on the part of the management to actually want to achieve a turnaround. You know, the most successful restructurings or recoveries are only done because they can see that the long-term goals which they're striving, is going to be a successful outcome for everybody. Yeah. And the trouble is, they've got to recognise that there might be some short-term pain in getting there.
What about sort of information? Because often when I get involved in one of these situations, there's a lack of real, reliable, up-to-date information, and you can't achieve a turnaround, Paul, can you, without reliable, up-to-date, realistic information, financial information on the business?
I agree. I think it's financial information, but it's also the execution of an improvement plan in the operations of the business. And funders will have a lot of more confidence if a management team is seeking external assistance in building that plan. There needs to be a plan B at all stages of the process. So there'll be a turnaround plan A, but I don't often see any plan hit on the nose. I mean, it may be above, it may be below. Plans don't tend to come out exactly as they've said. You have to have a contingency plan in the locker at all times.
What about management? How, as a lender, how do you feel about leaving the management in place?
Because we've been through good economic times until we've come up until now. There's many businesses that haven't been through a downturn cycle. So the starting point from a funder's perspective is to trust management. They've built a business. They have built a successful business. They've achieved something there. They're skilled at what they do. The management point is to maybe supplement management in certain situations to say you may need some additional assistance from somebody who's dealt with a downturn for a period of time.
A professional...
A turnaround director, an interim manager, somebody who can come along and be objective. You talked about being objective earlier, and play devil's advocate with the management board, so management are not too close to the problem and they can steer them through the choppy waters.
The important thing from a legal perspective, in my view, and it's probably the most important point, is actually making sure you're checking yourself regularly against that plan. And, you should be increasing the frequency of your board meetings. I'm staggered sometimes when I go into businesses and they've not had a board meeting for, an age. It's not just about minuting against the plan, it's actually recording the decisions you've made in the context of the reasoning behind why you're making those decisions. And of course, what directors don't always realise in these challenging times is that their focus changes. Particularly if we're talking about an owner-managed business, they've got their interests of their shareholders at heart. And in distressed situations, actually that emphasis changes and their creditors become the key. Yeah.
The result is that there are options out there, there are avenues out there, and it comes back to the thing we keep talking about, is if there are some underperformance issues, if there are some stresses within a business, for whatever reason that may be, it's early engagement. It's getting a professional team around the situation and making sure that it's taken in the right direction moving forward.